Welcome back, members. Please join us in giving a warm welcome to our esteemed speaker, CA Sumeet Khurana. I request our chairman, CA Manjunath Hallur, to escort the speaker to the dais. Today is a joyous occasion because it's speaker's birthday. Please join us to greet him. I will also recognize the presence of a speaker, regular speaker, CA Deepak Chopra and Naveen Kaiwal, sir. Before I introduce the speaker, I request our Sikasa chairperson to announce the students' event. Thank
you. Thank you, sir. A very happy afternoon to all the members here. Okay, I understand post-lunch our energies are slightly low. A very happy afternoon, everyone. Good afternoon, great. So I'm here to give a small announcement on a student's flagship program. We are going to conduct a program called as Sambrama 2.0 in the same auditorium on 14th December being a Sunday. What is this program all about? So we as CAs or during CA studies, we are always focused on studies, education, pass, exam, all this stuff. But we also do not recognize that we have a lot of talent within us. So we would have already heard about something called as America's Got Talent, Britain's Got Talent, Australia's Got Talent. Same way, we are starting CA Students Got Talent, CASA's Got Talent. It's a pan-India initiative. We are doing it in Bangalore with all the students with their best capabilities going to come and present here, and we'll have celebrity judges judging them, and we are going to create a flagship program for ICA as a whole. So I request you encourage all your articles or known CA students to come and participate in the program as a participant, give their auditions and things like that. It can be any art, any form, any entertainment that can be performed on the stage. This kind of program is one of its kind happening in India. So I request you all to encourage your students, articles, or known CA students to join the program once as a auditions for to be a contestant one way. Another thing is make sure they join the event as a participant as well. So with this, I would like to end this announcement. Thank you. Over to Chandra Prakash sir.
It's a pleasure for me to introduce our speaker, CA Sumeet Khurana. He is qualified in 2001 and throughout he has been extensively handling taxation. For the last 1 decade, he has been focusing on litigation in relation to that he appears ITAT, SESTAT, VAT Tribunal and other appellate tribunals. With very brief short introduction, I welcome the sir and hand over the session to you.
Very good afternoon all. If I can just make a small request to those who are sitting in the little behind, can come forward. It will be a little better for all of us to have an interactive session. If that request can be accepted, it will be really grateful. With that note, as we know that today's session is on penalty and prosecution, the most live example which I can think of, penalty, is sitting here today on the second half of a Saturday, penalty probably. Listening to me for next 1.5 hours is the prosecution. Some people have offered for compounding, they have gone away. So, just to start, how many of you would think that if somebody offers an extra income to tax more than what is actually earned, offering to tax, disclosing income more than what somebody has actually earned can lead to penal consequences? Sir, any reactions? Possible? Possible? Okay, great. How it is possible, sir? Why? So we will try to unfold some of these things like this. My idea is not to question you guys, but try to have kind of spark created in the session so that we can have a lively session. We'll just start with some, one basic case situation, nothing to be linked with the title which I have put there. Take a company, say ABC Limited, and they have earned income from some foreign country. And they have offered that income to tax along with the rest of the income earned from India. And they have claimed that taxes which have been paid in the overseas country, allegedly or supposedly, as a foreign tax credit to be set off against their Indian tax liability. And they get a reassessment notice challenging that foreign tax credit has been wrongly availed. And in the assessment, the foreign tax credit is denied. Can there be a penalty under section? I'll be most likely referring to the 1961 sections because that's still in the in memory, and I've not been able to imprint the new sections in my memory so far. Can the company be liable for penalty under section 270 capital A? The corresponding section 439 of the 2025 Act. If at all it is not liable, for I could see some reactions somewhere from all of you that it is not liable to penalty. We'll unfold why it is not so as we move forward. What if the claim is totally unsubstantiated by any evidence whatsoever? So I'm not seeking answers, I'm not giving answers, I'm parking this for the timing here. We'll just move on and then unfold these things, we'll come back to this. One very, very important principle when we deal about these things is the applicable law. Applicable law in general, and because of transition, what is the applicable, I'll touch on that. So take a hypothetical situation that income was earned in, say, financial year 21-22. And the year of filing return was 22-23. Income earned in 21-22, filing of return was to happen in 22-23 financial year, but there is non-filing of return. Or there is information called for during the assessments that under section 92D3, the information has been called for, that information has not been furnished, and for that the penalty is supposed to be levied. Now, assume that in financial year 21-22, the law applicable said that the penalty for not providing information is 2 lakhs. That is the law prevailing in the relevant financial year. By the time the person is to file return, the law changes and the law says, no, it is 4 lakhs penalty. And by the time the penalty is to be levied actually, the law is further changed, say 6 lakhs. The idea of his hypothetical case study is to bring home a point of applicability of law, which law is applicable. Now, the law about penalties is generally that you have to see as on which date the non-compliance happened. See, fundamentally what we know is law applicable as on the first day of the so-called assessment year so far is the law governing the taxability. But as far as penal consequences are concerned, that is not the proposition applicable. You have to see what is the non-compliance, what is the date of non-compliance, as on that date, what is the law prevailing. Ultimately, the penalty order may come years down the line. That's not relevant. So the change in between is not relevant, is what is flowing from judgment of Supreme Court, which I have put on the slide, on the bottom of the slide. So another very interesting situation which could actually arise, and it is very important to note this because we talk about the new law, supposedly trying to bring some ease and simplicity. So take a situation, the taxpayer has multiple international transactions amenable to transfer pricing. in his transfer pricing report, the taxpayer entity has disclosed, say, 5 out of 6 transactions. Hypothetically, have taken some 200 crores worth of 6 transactions, aggregating it to some 200 odd crores is the transactions, international transactions the taxpayer has undertaken. He has disclosed roughly 200 crore worth of transaction, some 5 lakh worth of transaction he has not disclosed. Now, the law says if you have not disclosed an international transaction, you are liable to penalty of 2% of the value of the international transaction. Now the question is here, the value of international transaction not disclosed is only 5 lakhs. But the total value of all international transactions put together is 200 crores odd. Whether the 2% penalty should be levied on entire value of all transactions put together or only on the transaction which is not disclosed. Now I'm sure all of you would agree with me on the logical standpoint that the transaction which has not been disclosed should only be subjected to penal consequence, right? But very, very unfortunately, so far and fortunately going forward partly, the law which was worded so far was that if there is a non-compliance for reporting a transaction which should have been reported, then 2% of value of each international transaction is the penalty. That's the law, how it is worded in 1961 Act. And to my knowledge, so far what cases I have handled, nobody has been that draconian in terms of ground reality. People have not really been so harsh in implementing the law and applied logic more than the text of the law and levied penalty only 2% of the transaction which is not disclosed. But the language of the law was very draconian, if I say. Now the language stands modified to take care of this problem and clarify the point that it is only the transaction which is not so disclosed. So this was one welcome change. Now I'll touch upon the most common penalty clause or the provision which we come across, which is the penalty for underreporting or misreporting. You filed your return of income and it has been assessed to a higher number. Or there was no return filed at all and income has been found to be assessable to tax, or return was filed, assessment was done, and thereafter some reassessment has been done that has also escalated the taxable income to a next level. So in all these kind of cases, the law provides that whatever the underreporting has happened, on that whatever income has been underreported, tax on that, 50% of that tax is your penalty for underreporting. And if the underreporting meets the criteria of misreporting, then 200%. That's what the basic we know. Now the way this section is worded is that these authorities, the assessing officer, the commissioner appeal, whosoever is empowered to levy the penalty, he may, during the course of the proceedings, direct the taxpayer that he shall be liable to pay this penalty. So there are two words in this. At one limb it is may, the other limb it is shall, which can at times lead to some kind of confusion. But the law on that point is that because the officer's right or the authority is coupled with the word may, therefore it is not mandatory for him to levy the penalty, and there can be situations where you can demonstrate that the penalty should not be levied. It is not a mandatory one. Now, one of the important aspect in this is you filed your return of income. It has been processed under section 143(1). And in that processing, the quantum of income has undergone a change. It has been increased, some disallowance, etc. has happened. Whether this incremental income will result into underreporting penal consequence. Now, the way this section is worded is, in the underreporting definition, it doesn't deal with the situation of comparison between return of income and 143(1). It starts from assessment compared with the assessed income compared with the 143(1).
So on one hand, we are clear that if there is an ITR filed, which is unit disclosing your income, which gets enhanced because of 143(1) adjustment, there is no penal consequence under section 270A. But is the situation same for a loss case? If you file, if there is a loss return filed, and under 143(1) processing, because of some dishonest, etc., the loss gets reduced, whether that situation will be resulting into penal consequence. On parity, if you think, of course, it should not, because the logic for treating the two should remain the same. If on the income side there is no penal consequence, why should be there penal consequence on the loss case? But the way the law is worded is slightly differently. There is a separate subsection in the new act and an explanation in the existing act, which says what is the quantum of underreporting income, how to quantify that underreporting income in a loss situation. So in first place, it says underreporting is defined to include reduction of loss cases. And in later clause, it says that in case of loss reduction, I'll tell you how to compute it. Don't apply your logic. And it says that difference between loss claimed and loss determined, or difference between loss claimed and income determined. So it gives a stepmotherly treatment, unfortunately, to a loss situation. So as a result of that, if you take a look at the numbers as an illustration, in the middle of the table, there is, case of income, say return of income was filed for 10 lakhs, and 143(1) adjustment took it to 12 lakhs. Assessed income finally under 143(3) is 15. So the underreporting for this income case is only the difference between assessed and 143(1), which is just 3 lakhs. But in a loss situation, it is the entire difference which gets treated as underreported income. Now, we cross that bridge that yes, there is allegedly some underreporting, but then how to deal with that? This separate subsection deals with various excuses or escape routes as to how to overcome this penal consequence. And the subsection, see, the first thing it brings out is if you can demonstrate that your claim was bona fide, there was some justifiable reason for claiming it, you had a belief that it is available based on some reasoning which is acceptable to the courts. There have been cases where during the assessment proceedings, people have realized that I have failed to offer a particular income to tax, I have claimed an expenditure which is actually not claimable or allowable, and before the assessing officer is able to pick that and question the taxpayer on that, there is suo motu voluntary compliance by offering that additional piece of income to tax or offering that piece of expenditure for disallowance. In such kind of cases, the courts have been liberal to say that it's a suo motu voluntary compliance and should not be treated as a mala fide intent. And on account of bona fides, they have been granting the benefit of waiver of the or non-applicability of the penalty. There have been some cases which have kind of put this on slides, may not be necessity of running through the facts of each and every case. Like that, this case has been very interesting, wherein the taxpayer unfortunately by mistake claimed, and other categories which will fall into misreporting are where the expenditure is unsubstantiated. The claim of expenditure is unsubstantiated, not corroborated by any evidence. Now here I would like to revisit what we discussed in the very first slide is, you claimed a foreign tax credit, and that is found to be not sustainable, and you have not been able to lead any evidence for that. Will that fall into this category? This clause talks about claim of expenditure if it is not substantiated by evidence. Now the question therefore is, is foreign tax credit a claim of expenditure? It is not a claim of deduction of the expenditure per se under business income. It is not a claim of deduction of that expenditure, but it's a claim of expenditure. There is no doubt that the tax is also an expenditure. Tax is also an expenditure. We are not able to claim a deduction of that as a separate thing. So foreign tax which you have paid is an expenditure. You are not claiming a deduction of that, but a credit of that. And this clause here does not talk about a deduction of expenditure, but claim of expenditure. A claim could be in a different form. A claim need not be a deduction. A claim can be credit also. So that's the aspect I think we need to kind of ponder over. Any reactions from anybody? Precisely, that's the most important point. See, underreporting is the first starting point. Misreporting is an incremental on that. If the case does not fall into the category of underreporting, it can never go to the second category of misreporting. Because misreporting has been defined to be that kind of underreporting which satisfied ABCD criteria. So this will be a case of tax differential, not a differential of income assessed versus income offered to tax. It's a case of straightaway tax differential. It is not a case of underreporting of income. Therefore, question of misreporting does not arise. There could be other consequences of this kind of mischief, but not this. The second other category is failures. So three categories of failures have been treated to be cases of misreporting. One is failure to record investments in your books of accounts, which means basically undisclosed assets. Failure to record a receipt which has bearing on your income. And failure to report transfer pricing transactions, the international transactions, or even specified domestic transactions. So a failure to report a transaction which is similar to transfer pricing will result into misreporting. But then the question is, this clause, the clause which talks about this misreporting definition, it simply says failure to report international transaction which is required to report. It is very important that we lay emphasis on the language used as it stands in the statute books. Many places you will find that there is a failure to do something in a way it was supposed to be done. Now, how are we supposed to report international transactions? We are supposed to obtain a report of an accountant and furnish the same. This clause does not say that you have failed to report in accordance with section 92E. It says you have failed to report. It doesn't say you have failed to do compliance with 92E. Your failure is, it is not linked to that particular section. Can you take a position that if during the course of your assessments you figure out that no, there is some international transaction, I have missed it out. Before the AOTPO picks, let me put it across, report it, and get it determined. It happens. We've seen very many situations, practical life. There are taxpayers who have taken a position that particular transaction is not to be reported. Finally, they realize it has to be reported. If you report during the assessment proceedings, can you say this clause, I'm meeting this clause because I'm reporting it? In what fashion and manner that this clause does not really talk about? The last and most important limb is the falsity. If false entries are recorded in the books of accounts, then it's a case of misreporting. Now, one of the very common ways of defending penalty notices, and thanks to the tax department, the way they function, and we capitalize on their inaccuracy, imprecision. When they send notices for underreporting, misreporting, there have been a lot of cases that it is not specified under which clause of that relevant subsection the misreporting or underreporting is alleged. When there is no specificity in the notice, we call it as a vague notice, and on account of vagueness, the courts have been striking down the notices, that the notice itself is the invalid notice and the consequential proceedings taken on the notice are therefore consequentially bad in law. So even though a taxpayer might have gone wrong, even because the tax department has also gone wrong, therefore your mistake, my mistake cancels both mistakes. So if the notice is not very precise and clear, so far largely the payers have been able to succeed in courts on the point that the notice has failed to allege the exact subclause of the relevant clause or the section or subsection. But I must caution, because what happens is, I keep saying this, tax is kind of a battle or a race. In a battle, who wins? The one who is with dharma? Not necessarily always. It's a continuing battle. The one who is mightier, that's the person who wins. Who's right not necessarily win. One with might has to win. That's the reality. So therefore, what is right we will discuss. Might has been so far with the taxpayers. We will see what is right, at least what I believe to be right. The whole foundation of this contention that the notice is imprecise, it is vague. Ultimate foundation is because of vagueness, the taxpayer is prejudiced. He is not in a position to defend his claim properly because he does not know what is the allegation against him. If I don't know what is the allegation against me, how do I defend my case? And that is because of vagueness, it has deprived me of a proper opportunity of defending my case. Now, this kind of thing has once, very long back, in the case of Anandji Haridas, in a sales tax case, 5-judge bench, constitution bench of Supreme Court has considered similar thing. There were 2 clauses in this section, and the sales tax officer could not strike off one of them for sending notice. The court said, don't you know that your case will fall in clause A only, and it is impossible to fall in clause B. You are a registered taxpayer, clause A is for registered, clause B is for unregistered. There is the doubt, where is the ambiguity, even if the officer does not strike. So therefore, if the rest of the documentation and the narration, the assessment order is sufficient to demonstrate which clause is applicable, then this kind of story may be short-lived. One day we may get overturned, but nonetheless for the time being we can try to use it. And some of these things are first mover advantage. Like something has come today, document identification number, DIN number not there in the orders. The first mover advantage, they have succeeded, their chapters got closed. Remaining are lying in a batch. What will happen to them, God knows. Now, another important facet is section 274, which is supposedly the section which talks about issuing notice for penalty. Before passing order, issuing notice of, even notices say that it is not 274, but if you read section 274, it does not whisper, it does not talk about issuing notice. It talks about if you given an opportunity of being heard. And very similarly, section 263, which is about revision done by the commissioners, that section also does not talk about giving notice, but talks about giving opportunity of being heard. Therefore, the rigors of notice, validity of notice should not apply, is what the Supreme Court held in the case of Amitabh Bachchan. क्योंकि लाइन वहां से शुरू होती है जहां हम खड़े होते हैं. Anyways, then we get to our immunity booster rules. Section 270, capital AA. Even though penalty has been initiated, you can seek the immunity from not only the penalty but also of prosecution under section 276C or CC if you comply with 270 AA. The objective of this section, as held by some courts, is to avoid litigation, and as I told that my bread and butter is litigation, they just want me to look for some other opportunities in life. So to reduce litigation and incentivize more compliance and suo motu payment of taxes, this section they said introduced. And what are the conditions for availing this benefit? there are multiple conditions, but we have to very meticulously categorize those conditions into different baskets. Only then we will be able to make good sense out of the section. The first set of condition is the eligibility conditions. For filing the application for immunity itself, subsection 1 says certain conditions will be met, which is your tax and interest should have been paid according to the time given in the notice of demand. And no appeal against the assessment order should have been filed. That's the second condition. Then there is a disentitlement, that you should not file appeal. So if you have not already filed, you will not file also. Then application should be within 1 month from the end of the month in which assessment order is received. So this is a separate subsection which says that application should be within 1 month of the getting the assessment order. Then assessing officer's obligation is that he has to adjudicate on your request within 3 months of your receiving the request, and if he wants to reject, he should grant you an opportunity of being heard. And immunity has been held to be right of the taxpayer. If he satisfied the given conditions, then it is not left to the discretion. Once you satisfy the conditions, it is obligation of the officer to grant you. Now we will deal with a company, and this company's name is Mischievous or Ignorant Limited, MOI Limited. What happened in this company's case is, transfer pricing additions were made in the assessments. So, assessment got kept up, referred to transfer pricing officer, he made some adjustments, the taxpayer went to dispute resolution panel, and as it happens with most of us, DRP did not accept the contentions, matter got back to the assessing officer, order finalized as per the proposed additions. Now, after the assessment order has been, final assessment order has been passed, after the DRP, this MOI Limited, it files a application for immunity, and after that files a appeal before tribunal. Now, therefore, the question is, this MOI Limited is mischievous or ignorant? We said that appeal should not be filed. Appeal cannot be filed. He is trying to play. So he is not reading the law, he is over reading something. Sometimes, whether somebody is mischievous or ignorant is only a matter of time. Today you will feel he is ignorant, day after tomorrow some development will show he was mischievous, and then sometime finally he is ignorant only. So we'll just see how we can think about it. As I said, the different conditions in these sections have been basketed under different subsections. The subsection 1 says, for filing application itself, you have to meet A and B two conditions. Which are the two conditions? Payment of tax and interest. Second condition is, I have not filed appeal. So by the time I'm filing application, I have not filed appeal. Isn't that? And that says no appeal. No appeal. But this another last subsection says, you should not file appeal under section 246 and 246A and revision under section 264. So the first level prohibition is for any appeal whatsoever, but the last level of prohibition is only for appeal before Joint Commission Appeals, Commission Appeals, and revision before Commissioner. So therefore, it seems this person is like trying to play a little smart and read something in between the lines. Disablement of disqualification of 253 section, as I said, tribunal appeal is not specifically called out. So can this company go ahead and enjoy the fruit of immunity as well as try to succeed in tax front? if you can help me with giving my throat half a minute rest and share your thoughts with me, I'll be grateful. Mic, I think. Anyways, you on the top of your lungs. Seems possible. That's right. That's it. Okay. So my learned friend says it seems possible. There is small, I'll say small, but small stumbling block. When you file this application, you have to file a form 68. The form 68 says, I wondered, it seeks a declaration from me. I shall not file any appeal. The form seeks a declaration beyond what the section provides. That's one problem. Can the form ask me to go commit more than the law? That's one thing. But there again, there is a catch. It says, I shall not file an appeal after this thing, any time before the time limit given under subsection 4. So subsection 4 is the time limit given to the officer to adjudicate my case. So before that I cannot file. After that, again. So another catch is, assessing officer has 3 months. By the time your tribunal appeal time limit will be over. So you'll have to file a tribunal appeal with condonation. And the beauty is condonation reason will be, the form is forcing me to do that. I want to avail immunity. The form is forcing me to do that. Therefore, I had to wait and let the time pass by. And therefore, that's the reason of condonation. The another important facet is that this immunity cannot be granted if the case is of misreporting. Underreporting only they will say will cover. Misreporting, they cannot. I was talking to a friend of mine yesterday. He said that the assessment order said misreporting. He was still able to convince the officer to say that, no, it's not a case of misreporting, but underreporting only, and the officer gave immunity. Probably he passed 2 orders, one rectifying his assessment order to say that it is erroneously mentioned as misreporting, and then granting immunity also. There is this judgment of Kerala High Court which says that having passed an order and stating therein that it's a case of misreporting, the assessing officer cannot sit in appeal over his own order. He cannot review his own order to say that no, it's not a case of misreporting, I wrongly mentioned that. This is what this judgment says. Probably you have to strike a balance between what I said earlier and this one. But there is something very, very important. As I said you, that this immunity is not only from penalty but also from prosecution under section 276C and 276C. Now, on one hand, the immunity is not available if it's a case of misreporting, and immunity is available for prosecution. And these two things very difficult to stand together, because the prosecution is when there is willful, fraudulent conduct. And when there is a fraudulent conduct, there's definitely a case of misreporting. And if it is a case of misreporting, it is taken out of the immunity. But on one hand, you take it off immunity. On the other hand, you're saying you're liable to immunity from prosecution also. So somewhere there is some incongruency in this section. And probably the only way to overcome, or rather, clear up this incongruency is, see, one way of interpreting this law is that you should attribute sense to the parliament. Don't assume that they have given you something by one hand and taken it by the other hand. So they're giving you this immunity for 276C and double C. You should not presume that by virtue of this misreporting that it is taken away. So the only way probably I can reconcile my thoughts about this section is that if it's a case of some fraudulent misconduct which falls into misreporting category, then it is not a mandatory obligation of the officer to grant you immunity, because it requires subjective satisfaction of the gravity of offense and all. It will be an subjective decision on, of course, on a judicious parameters, that he may grant you that. It is no longer a mandate on him to grant. Because whether you are meeting the conditions, rest of them are very objective conditions. You paid the tax, you paid the interest, you're not filed the appeal, objective conditions, officer is obliged to give you immunity on that count. But if it is this kind of fraudulent misconduct, etc., then it will be his discretion, judicious discretion is the way I can look at this provision. Now, another very regular problem which occurs in relation to this section is that suppose the assessment was alleging that you have a expenditure that needs to be disallowed, say 25 lakh worth of expenditure to be disallowed. And you are also clear that it is to be disallowed. You want to close the matter. Assessing officer while placing the order, there is an arithmetical mistake. 25 lakhs becomes 2.5 crores. 1 0 added, your life gone for a toss. Now, because now the demand is on 2.5 crores, you want to settle the case on 25 lakhs because 25 lakhs you are admitting that it is correct addition. But because this has happened, how do you navigate the situation? Because if you want to seek immunity, you have to comply with payment of tax within the time limit given the notice of demand. If you think that let me pay tax on the higher 10 times of the amount and get immunity, thereafter seek rectification, and after that seek a refund, we know how refund happens. And if you think that no, I will wait for the rectification first to happen, I will seek rectification. Once it is rectified, then I will seek immunity, whether my time limit will be lost. Because time limit is 1 month from the date of receipt of assessment order. The rectification itself will take months. So how will you match that? There are two things in that. One, there is one theory that every rectified order again gives you a fresh lease of life of time limitations. Not a very well established theory, but there are certain judgments this way, there are certain judgments that way. Little risky proposition. The other proposition is, as I was telling you, different conditions are basketed under different subsections and we must give importance to how they are bracketed under different clauses. The first subsection says these are the conditions for even filing the application. I filed it. The rest subsection simply says you shall file application within 1 month. Okay, sir. Now, word shall, we all know it is mandatory. Once the subsection says you shall file appeal within 1 month, it's mandatory. But that's not the end of the road. It has not been linked to your sustainability of the application under subsection 1. That's one point. It does not say that for the purpose of availing this immunity, you should file this. Or it is not even, it could have been a subclause of subsection 1 itself, that they have not done. So the consequence of failing to comply with this 1 month is also not provided. And on the top of everything, the Limitation Act, section 5 will say if there is a reasonable cause for delay, then that can be condoned. Unless the applicability of Limitation Act is explicitly or implicitly carved out. So there we can play that, the Limitation Act applicability is not carved out. This section, even though uses word shall, it does not provide it for negative consequences. And based on some arguments like this, there have been certain judicial precedents to say that the officer has a power to condone. So it may be a better idea to seek a rectification first, reduce the quantum to the appropriate level, and then go for immunity. Now we said that assessment you cannot appeal against. The assessment which has resulted into addition and consequential penalty, etc., that you cannot appeal against, except for the 253 tribunal appeal, which is in limited circumstance we can do. But the question is whether this order of rejecting my application, can it be challenged? There's a negative order against me. Order says you are not liable, you are not entitled to immunity from penalty prosecution. Is that order amenable to any judicial challenge? Now the common most judicial challenge is appeal before the first appellate authority, joint commission appeals, commission appeals. The respective two sections of these two appeals, they mention which are the appealable orders. This does not fall there. So therefore, because this order reference does not fall into the list of appealable orders before the JCA and commission appeals, it is not appealable before them. However, there is no bar on getting it revised by commissioner under section 264. There is no bar on that. There is no bar also if this situation permits, if the volumes are high, if this grounds of some natural justice, some lack of jurisdiction exist. A writ is also a remedy which is not carved out. So the possibility remains before commissioner under 264 and writ court in extreme cases. I'll probably, in this interest of time, maybe skip, I think, some of these things are a little mundane. Yes. So I was talking about on the first slide, if you report income of a level higher than what you have earned. So 271 AAD of the 1961 Act and 441 of the new law. There again, very interesting development. This section primarily says if you are making false entries, which includes invoicing without supply of goods or services. You are raising invoices or you are recording invoices without actual supply of services. You are raising invoices for supply of services or goods and there is no buyer in existence. So on non-existent persons, you are beefing up your sales or you are beefing up your expenses. So even expenses false entries as well as revenue false entries are liable for penalty under this section. And the penalty is also not small, equivalent to the amount of the transaction you have recorded falsely. And to my shock, this section said who's to be penalized? The person maintaining the books. Now, if I am in the profession of maintaining books of accounts for others, God save me. And the kindness of the officer, if he doesn't, he is not after my blood. Fortunately, and very interestingly, I don't know which way it will take us to, in the new section, they felt that no, that person should not be penalized. But they also felt clueless who should be penalized. And they are not called out who can be penalized in this. The new section they have drafted is, it doesn't very clearly mention who is to be penalized. They say situation, this situation is to be penalized. Which situation? False entry situation. Who is to be penalized? Not specifically called out. So this can result into a situation when nobody can be penalized. Especially you should compare with the old act and say, hey, lost. And there is another subsection to this about a person who facilitates this kind of mischief. So that subsection also applies because they say if A is facilitating B to do this, but who is B? B is unknown. Then A will also escape. Maybe I'm too aspirational in what I'm saying, but these are the things probably we can look at if somebody is really into deep trouble and this is called arguments of desperation. You're forced to the wall. There is no escape route. Something you think of to do is save yourself. Then there is, what I would like to call a master key of most of the penal provisions. The section 273 will say, show some reasonable cause of non-compliance of the sections. We will try to get you out of this penal consequence. What can be these? There can be a number of things we know. Most common, that concerned person was, new to the organization. He fell sick. Some misfortune happened. Financial crisis in the company, XYZ. The list is long and is more of imagination at times. With this, we'll now deal with the prosecutions. And in prosecutions, it's actually, as of today, far simpler because prosecution has become equivalent to compounding. The guidelines of compounding the offenses has been so much, become so much flexible and open to accept vast variety of cases. In fact, the most of the obstacles have been removed. That by and large, when it is prosecution notice, we will run for compounding. But before we really do that, a little bit of time on certain things in this. I will not touch with certain mundane things already. I think it's too taxing to deal with this subject here. One very, very important thing is that we know natural justice. Anything to be done against me, first you serve me a notice, give me an opportunity to defend my case. Prosecution notice, is it necessary for them to give me a notice first and they can straight away file a complaint before the magistrate? Court said yes, they can file, no problem. Trial court will see, try your luck there. Not issuance of a notice that I want to launch prosecution, you have any case to defend yourself, not required is what the court said. Gracefully, the board issued a handbook or manual in 2020 saying that no, we will have this procedure internally where a show cause notice will be issued by the principal commissioner or commissioner. So, thanks to the wisdom. Now, once again, I'll kind of draw again to something similar what we discussed in penalty section is law applicable. Substantially something similar as what we discussed is, if in 2020, in 2021-22 is when you earn the income. The return was to be filed in 22-23 and assessment etc. is happening or prosecution is happening sometime later in the day. And in these different years, the law which deals with whether a particular conduct is an offense and if it is an offense, what is the tenure of your imprisonment etc. or fine and penalty, that undergoes a change. So which law to apply as on which date, quite similar to what we discussed in the context of penalty, that is on the day when I made that mistake, I committed that offense, in which case, for example, if TDS was deducted and not deposited, then the offense got committed on the due date it was supposed to be deposited. So what was the law on that date? That will govern my fate. But so 276B and BB deal with TCS and TDS failure to deposit, having deducted. If you don't deduct, then penalty. If you deduct and not deposit, then the prosecution, and not depositing TDS, which are not to be deducted like 194 are to be paid from your own pocket, 194B, etc. And the defense available is that there is a proviso to the section. That proviso says that after having deducted tax at source, you have not deposited under the due date, but it deposited before the due date of filing TDS return. Okay. We'll be happy with that, will not prosecute you. This came into existence in October 2024, this proviso. There is another escape route which is in the coming from a circular of 2019 which said if the amount is small, they specified 20 lakhs. If the delay is small, they specified 60 days, then will not prosecute. So generally your first escape route that there is payment by the due date of filing return will be saving you. In a case where your non-compliance in the last month and return filing is due in within 30 days, you may fall back on 60 days which is flowing from the circular subject to 25 lakhs of the total quantum involved. Now, some clauses of some case laws, which I will not really burden you all, of what could be reasonable causes for failure to comply with TDS, grave financial difficulty, some insolvency proceedings going on, some grant was to come from the government again, financial crisis kind of things, or the concerned person, some mishappening, all those things. So these are the kind of cases which have largely been treated as a reasonable cause. We'll take a case situation here. Financial year 23-24, the TDS return for the quarter ending March, due to be filed on 31st May. 23-24, Jan to March quarter, TDS return due by 31st May. And the TDS for the January month is paid with delay on 27th May. So it is paid before the due date of TDS. But this all has happened in May 24, and the proviso which gives us the leeway has come into existence in October 24. And what we learned was law applicable on the date of commission of offense. So, what do we do? How do we say that best of the two? I'm sorry, I could not hear you. So, that's what heart says or mind says or both? It's a statement from the heart or mind or both?
Both.
Both. Okay. So my friend is saying that upwards should not be applied and downwards should be applied. We must understand where does it emanate from. I agree with him, and not that I have my own independent thoughts. Unlike him, I am dependent on some judicial precedent only. So where does it emanate from is, on the date you do something, you do based on your calculations of what will happen. So you did not bargain for this. Something going upward you don't think of, probably you would not have done that. That deterrent has come later. That could have deterred you. Had you been knowing it, you were not knowing it. That deterrent was not there. So therefore, any upward thing should not be, applied on you. Downward thing by natural force should apply is what the Supreme Court has also held in good number of cases. So I put down something, the slides will be shared with you all. So it's a best of two, end of the story. And one small thing, there's sometimes transactions with foreign companies are structured in a way that, foreign company says, I don't care about taxes in India. I'm already drained with taxes in my own country. You bear the taxes. And you pay me net of, my consideration is net of taxes. And you have done that. $100, or not small, say $1 million. $1 million is the service fees. You paid him fully, no TDS compliance. And then the assessing officer says, sir, you should have complied with TDS. And then now I will believe, because it's a gross, your TDS you are supposed to pay from your own pocket, not deduction and payment. It is from your own pocket. That's what you have agreed with your supplier. So you will believe that TDS has been deducted and not deposited, and therefore liable to prosecution. It's a no, far-fetched, like all of my examples. Okay, reasoning. Sorry? So how do I ascertain? When the transaction is, I will have to pay him $1 million, whether I have deducted and kept with myself, or kept with myself without deducting. In any case, I was to pay from my pocket only. How do I demonstrate that? I don't disagree with what he's saying, but the real question is, how do we demonstrate that? Now, to demonstrate that I have not deducted, probably, if I have taken an opinion from an external professional that TDS is not deductible, then I'll say it's not deductible because it's not deductible. It's the view adopted. 15 CACB filed, that also says not deductible. So there are two external documents to say that it is not deductible, therefore I have not deducted. Otherwise I find little fluid. If you say, look at my ledgers, there is no deduction entry. That may be little difficult to canvas because your ledgers are in purely your control. It could be made the way you wanted it, and therefore may not be the best evidence to lead. So this question is not more of what is the legality, but how to defend the situation more from a documentation perspective. So in a case like this, when the volumes are high and you're taking a stance of non-deduction, it is better to document it. 15 CACB is in any case there, but better have a professional advice also on your records to showcase your position. Largely, there are certain things which lead to penalty, certain things which lead to prosecution. But some areas where same non-compliance will result into both. And that is where we have to be a little more careful. Return not filed, 270A penalty will happen, and 276CC will also parallelly can happen. False claim in the return, 278 AD penalty will happen, 270A can also happen, and 277 prosecution can happen. So there will be cases where parallelly both things can have their own litigation proceedings. So it can be double whammy in that sense. And it is important therefore to factor what is the implication of my merit proceedings, the assessment, the appeal thereafter on one hand, and the prosecution proceedings on one hand. The courts have said that no doubt the merit assessment and appellate proceedings have a bearing on your prosecution in these overlapping cases. When they have a bearing, can you launch a prosecution even before these things are concluded, or you have to wait till end of the day and only then launch prosecution? Court said, no, you can't wait for that. You have to launch prosecution. You can launch prosecution even when these things are going on. But then they have also said that probably you can get them stayed. And in between, if you succeed in your merit cases, so what has happened is, in your assessments, the court said, I am quashing the assessment. Your returned income is accepted, assessment is nullified. Whether prosecution will automatically come to an end, whether the court should say that yes, it need not be continued any further, because the substance, the substratum has also gone. Two categories of cases. One, where you succeeded on merits by saying that there was no adjustment to the income required. Second category of cases is the notice was time barred, assessment was time barred, data was not there, that thing, those all jurisdictional grounds and technical grounds. If you succeed because of those technical grounds, prosecution will independently continue. But if you succeed based on the merits of the disallowance, then prosecution will come to an end as a natural consequence of that. And to cut the long story short, as of today, as I was saying, largely it has become, if you have some prima facie very strong case to say that prosecution notices are void and invalid, which is happening in a lot of cases. What is happening on the ground is that there will be a notice saying that TDS default is there, why should prosecution not be launched? And if you dig your facts, what you realize is it is not a case of delayed deposit. It's a case of delayed deduction. Unfortunately, floodgate of notices had come in last few years, wherein there was delay of deduction, which is just a penalable but not a prosecutable. So those kind of cases, and where you can have an outright defense of small delays or things like that, you can probably try for some time that the officer himself drops it. Else will go to compounding, and compounding has become, as I've said, very, very liberal today. At some point of time earlier, if you are convicted once, you cannot go to compounding. You cannot go to compounding for more than X number of times, 3 times or so. So today you can go to compounding n number of times. There is no limit on how many times you can go for compounding. The only thing is, the more number of times you approach you knock their door, the fees is higher. If you go for the first time, it is, the charges are given, say 1.25% of the your per month of your tax in dispute or the TDS not paid in time. But if you go second time for the same offense, it is 20% extra. You go third time for the same offense, again 20% extra. So it becomes 1.2 times, 1.4 times, 1.6 times, like that. That's the adverse consequence of multiple times. So basically they want to set your things right. But they're saying that earlier there were certain offenses which were not even open to being taken for compounding. But now there is no offense which has been left out. Any kind of offense you can go for, get it compounded. Even the cases where the compounding was rejected earlier because the person has got convicted, you can now have an approach and get the compounding done. So given that liberalization with which the compounding has now happened, and even the past rejections you can take back again, I think it is largely the case of settling the things, unless it's a case of prima facie demolition of the notice based on the things as we have just discussed. I think that's largely what I wanted to cover today. Thank you so much for being here and patiently listening to me. So I was trying to avoid any questions, but he's forcing me to face questions, so please. They're very kind to me, sir. Thank you so much. Sorry. Okay.
Yeah. So in your previous example, MOA limited, so since it's a TP or a non-resident case, the assessee would have received draft assessment order.
First, yes, first draft assessment
Yeah.
order,
So-
then DRP, then back to final assessment order,
Yeah.
then.
Exactly. So in that way, is not eligible for filing Form 68, or he can't even go for immunity because there is no order, there is no demand raised, and only after that only he can make the payment of the taxes and the interest within 30 days.
Sir, after the final order I'm talking. The draft order, then DRP, then final order. After the final order, it's just like any other regular assessment.
Okay. Okay. And another question. So the granting of immunity from a AO perspective, it is discretionary irrespective of the fact that whether it is a misreporting or under-reporting. Because in a couple of my cases, even though I tried asking them that, okay, even if it is a misreporting as mentioned in the assessment order, okay, they particularly tell that no, only if it is under-reporting cases, I have a discretionary rights to do it. If the circumstances falls under section 270A(9), then it does not come in my purview, and I'm not have any rights to give the. And in cases where, let's say example, I'm just giving an example. Let's say example, from beginning of the assessment proceedings, right from very first 142(1) notice, I am trying to, I mean, though it is a cover-up, let's say example, I'm trying to play a victim card stating that I just hired one professional to file my return without my knowledge. He filed the return and he made some bogus claims and deductions. So I ended up getting some huge amount of refund. And since immediately I got the notice, I tried to rectify it by accepting the fact that yes, there is a mistake and I've accepted it, and I am ready to be I'm supportive in all these assessment proceedings and right to pay back all the refund that I've received. See, I did this ultimately to get the immunity at a later stage. So as per your wordings, let's say example, if there is a voluntary disclosure and trying to admit the mistake or whatever, even though it is a deliberate, I mean, maybe I'm not telling that, I'm not, being an assessee, I'm not telling it is a deliberate, but even at a later stage, why I'm not eligible for immunity, though it falls under 270A(9).
So I think two things you're looking for. One is, what I said was how the officer should do, and what you're saying is how the officer does. And there is always a dichotomy between that.
Yeah.
So that's one thing, okay. When it has to be granted, officer still does not grant. That's a reality, but that's not the law. Now coming to a second thing, it's like we are saying that some expenses, bogus, whatever got claimed at all. It's like handling fire. Handling fire, you have to handle with care. You can cook food, you can burn fingers. So how you project that whole thing is going to decide your fate. So how you project your facts, I think that is what is going to be material. Rest not in this hall, maybe separately while we shake hands. That's it. Okay, thank you all. Thank you.
We have reached end of what a truly an insightful and engaging session. Before a formal vote of thanks, I request our chairman, C. Manjunath Hallu, sir, C. Vishnu Bharat, sir, C. Naveen Kariwal, sir, and Deepak Chopra, and all the MC members on the dais to join us for birthday celebration of our speaker, C. Sumeet Khurana. Sir. On behalf of my MC members of ICA Bangalore branch and members present here, I, C. Chandraprakashin, Managing Committee member, would like to extend our deepest gratitude to our speaker and request our chairman Manjunath Hallu to present a memento as a token of appreciation and gratitude. CA Sumit, thank you once again for your extraordinary generosity in taking the time to share our expertise with us. Especially on a such special day, your passion for the subject is evident and the way you presented the material was incredibly clear. It's a truly testament to your commitment and love for what you do and that you spend your birthday with us. We are fortunate to have learned from you. Please join us in a final big round of applause for the CA Sumit, not only for a fantastic session, but also wishing him a very happy birthday once more again. I also thank all of the members present here for their active participation and thoughtful questions. Let us break for tea and reassemble.